I'm going to start off with a couple of things about the fiscal cliff that didn't get talked about. And I've drawn two smiley faces on my notes here. That's hardly the only notes that I've got, two smiley faces, to try to keep it upbeat. It's a challenge. And I guess on that upbeat note, this morning the GDP numbers for the third quarter were revised up from 2% to 2.7%. Unfortunately, it was all because of inventory building, so it actually will make the fourth quarter a little bit weaker. It's interesting, having listened to everything and kind of jotted down some notes for myself beforehand, my read on the election, when I was in Washington the day after the election, and I was asked, was I surprised by the result? And frankly, I was a little surprised because I looked at the Gallup numbers and they had Romney winning. I think it was 51-49, and that was the last poll. And historically, the Gallup poll has underestimated the Republican vote by 2 percentage points, and they've underestimated challengers' votes by 2 percentage points. And I'm not a political scientist, I'm an economist, but I know that when you look at the economy, the most important economic number in determining whether an incumbent gets reelected, whether a sitting president gets reelected, is real after-tax income growth. And it has to grow. The bar is actually relatively low. Real after-tax take-home pay, that's kind of the best way to refer to it, needs to grow 1.6% in the year leading up to a presidential election, or the incumbent doesn't get reelected. And in the 12 months prior to this election, it was up 1.3%. No sitting president has ever been reelected with an economy that has performed this poorly, and it's actually lower today than it was 4 years ago. And rather than looking at the negative on that, I think that the result that we got suggests to me that the economic data has underreported what's happened in the economy. I think that it's not as if people call me up and say, Mark, I'm trying to think about how I'm going to vote on Tuesday. Tell me, what did that income number do? The way people make that decision is they base it on their own personal decision. How are they doing? How are their children doing? How are their friends doing? And I think that the economic numbers may actually be understating the strength, and the economy is doing a little bit better. I think that's why we got the result that we did. And so that is my striving to be optimistic. That's the good news. Now, the difficult news is that when you strip out the inventories, and there was an inexplicable, here we were talking about the fiscal cliff and bringing the federal government's house into order. Federal government spending actually added 0.3 percentage point to GDP growth in the third quarter. When you look at private final demand, and that's what makes up the bulk of, that's private businesses, that's what makes up the bulk of our economy, it grew at a 1.4% annual rate. And unfortunately, that's been the pace that we've seen, been much closer to the pace that we've seen in the private sector the last couple of years. And maybe it's understated, maybe it gets revised up, but it's somewhere stuck in that 2% range. It's not very strong. And with the fiscal cliff approaching, and with some very tough decisions, I don't even know if you should call it a fiscal cliff, but people always ask me, they say, well, Mark, are we going to go over the fiscal cliff? And I'm going to tell you, I'm 100% certain. I would say I was 99.7% certain that we're going to go over the cliff, but that would be giving me false hope. We're going over the cliff. There's not a doubt in my mind. If people define going over the fiscal cliff, are taxes going to go up next year? Is spending going to be cut next year? Absolutely. And Senator Warner left out a couple of things. And since he went on so long, I don't feel guilty about pointing them out. But it's nonpartisan. It's not. I was actually on we called it the Joint Advisory Board of Economists back when Senator Warner was Governor Warner, and I'd been on both parties, and that some people get kicked off when it changes from year to year, but I've been able to give good advice to both Democrat and Republican governors. So this really isn't this wasn't brought up. One element of the fiscal, there's 6 elements to the fiscal cliff, really kind of 7. And 4 of them are absolutely going to happen. One of those is the temporary 2 percentage point reduction in Social Security taxes. It expires at the end of the year. And the Senator didn't say anything about it because no one's talking about it. It's not going to be brought up for discussion. That 2 percentage point temporary reduction in payroll taxes is going to end at the end of this year. And everybody's paycheck, everybody who works, is going to see their taxes, their withholding go up 2 percentage points on the first $110,000 in income. Most people in America make $49,500 a year, so that's on all of their income going to happen. The Affordable Care Act, or Obamacare, there are taxes that fund that take effect on January 1. The Affordable Care Act is the law of the land. It's going to be with us. The taxes that go with it, the 3.8 percentage point tax on investment earnings, the 9/10 percentage point tax on Medicare tax that hits on incomes over 200, household incomes over 250. It's the law of the land. It takes effect January 1. Federal funding for extended unemployment benefits. It ends at the end of this year. It's not going to be renewed. Bonus depreciation on capital equipment purchases ends at the end of this year. It's not going to be renewed. These things aren't even going to be brought up for discussion. They are just going to happen. So, to me, the discussion is really, are we going to plummet over the fiscal cliff? Are we going to slide over it, stumble over it? And we can handle this. I mean, but when you look at the GDP numbers, we've averaged 2.2% since the recession ended. And we think that in the fourth quarter of this year, it's going to be about 1.4. In the first quarter of next year, it's going to be about 1.2, because we're going to adjust to some pretty significant changes in taxing and spending policies. And I get to travel all over the country, and I've been to a lot of communities that have close ties to the federal government, and they all have one thing in common. There's been a chill in their economies over the last 6 months. That's Washington, D.C. That's Hampton Roads. That's Huntsville, Alabama, and where I was yesterday in Columbus, Georgia, which is where Fort Benning is. And it's in Augusta, Georgia, where I'm going in 2 weeks, where they have Fort Gordon and the Savannah River site. And there's lots of federal contractors in all of those places, and it's been very unsettling because they don't know how the fiscal cliff's going to be resolved. The issues that matter most to them have to do with the sequester, which we really haven't heard much talk about, and the extension of the Bush tax cuts. And the way that I think that's going to be done, and I'm going to try to move really quickly with this because I want to get on to Virginia, is that the way that I think the Bush tax cuts are going to be resolved is they are going to expire on December 31st. Because if they extend the Bush tax cuts for everyone except those that make over $250 a year or over $500 a year or whatever they decide, or they limit deductions, whatever they come up with, and they only got 2 weeks to do it, so they can't get too fancy, then Congress would be voting for a tax increase. And every congressman or senator that's up for re-election in 2 years would be voting for a tax increase, which would be one of the biggest tax increases in U.S. history. But if they let them expire, the last day of the Congress is January 2nd. That's the last day of the current Congress. They let them expire, and they come back and reinstate the tax code, the Bush-Obama tax code, for everyone except those that make over $250 or $500. Then they're voting for a tax cut. And so when they run for re-election, they can't be hammered with, you raise taxes, you raise taxes. They might still be able to, but politically it's more palatable to vote for a tax cut. That's how I think the Bush-era tax cuts are going to be handled. In terms of the sequester, if they do not deal with the sequester in a way that is believable to the rating agencies, then we are going to see a credit downgrade fairly quickly. And because that's why we came up with the sequester. It wasn't just to appease a bunch of renegade congressmen. It was because the rating agencies said, listen, you haven't been truthful with us in terms of your finances. You haven't been, it's not like they were like the Greeks, but they haven't been truthful. It had to do with the continuing resolution early in 2011, and when the truth came out about, instead of cutting spending by $40 billion, you increase spending by $100 billion. That's when all three rating agencies put the U.S. on watch, and that's when S&P downgraded us. So there has to be a credible plan to reduce the deficit. If you talk to Erskine Bowles and Alan Simpson, they said it was $4 trillion back in 2010. That's when Bowles-Simpson came out. We're $2.6 trillion further in debt today than we were then. $4 trillion, the number that Senator Warner cited, is not big enough. It's going to have to be $4.5 trillion or a little bit more than that to meaningfully reduce the deficit. Let me fast forward a little bit. I've got a lot of charts here, and I'm just going to hit three more. In terms of where the U.S. is and where we should be, this chart shows you potential GDP. If we were at full employment would be an unemployment rate of 5.25. If we were at full employment, we would be producing about $800 billion more goods and services right now, and there'd be a whole lot more tax revenue. You can see how deep this recession was. You can look at the 2001 recession and see what a more typical recession was. You see how much deeper this was. You can see how little progress that we've made in this recovery in recovering that lost ground. And that's one of the reasons that consumer confidence is the highest it's been in 5 years, but it's in the low 70s. No sitting president had ever been reelected with a consumer confidence number below 92. I mean, it's very, very low. Most consumers rate economic conditions today as very little better than they were at the worst of the recession. They're a little more optimistic about the future, and some of that probably has to do with the election. I'll show you that one. There's our budget deficit, and you can see that we've made a little bit of progress as we've been climbing out of the hole, but it is still over $1 trillion. Let me show you what's happened I'm going to run out of time, but I'm going to still work this in here. One last thing on the U.S., one more smiley face. There is one thing, when we talk about the fiscal cliff, and I've thrown the hard numbers at you, and I truly think they're bipartisan, I don't think that, unless they totally flub this thing up, I don't think that it's going to tip us into recession. And for one very simple reason. As I said earlier, the underlying momentum in the economy is probably a little bit better than people realize. And number two, the housing recovery is kicking into a little bit higher gear. Not high gear, but a little bit higher gear. The big change that we've seen out there is that we've cleared out enough of the foreclosures that home builders now face less effective competition. There's still a lot left, but a lot of what's left is geographically undesirable. It's too far away from where people want to live and work. It's either, or it's caught up in a legal quagmire and you can't get clear title to it, or it's physically in bad shape. And if you look at the inventory of new homes, it's the lowest it's ever been. The lowest it's ever been. We got 50 years in an absolute sense, even though the economy is so much bigger. And so home builders are going to do better next year. We've got about a 27% increase in single family starts. That's going to provide a real lift to the economy. So I think that even if we have some disappointment on the, and I guess one last thing on that, and the Fed is committed to buying mortgages for as far as the eyes can see. So they're going to continue to buy mortgages, $40 billion in mortgages, and keep mortgage rates relatively low for a while. Now, turning to Virginia, we still haven't recovered all the jobs that we lost in the recession, but we're only about a percentage point below where we were prior to the recession. It's much better than most other states. The latest job numbers are probably a bit understated. When you look at the quarterly census of employment, it looks like we added jobs we added about 60,000 jobs in the last year. But while the numbers are probably better than what's been reported, the quality hasn't been that as good. We've added a lot more jobs in travel and leisure. We've added a lot more jobs in retail trade, and we haven't added as many jobs, those high-paying jobs, at federal contractors. And as a result, even though job growth was better than we thought it would be this year, the absolute number of jobs created, income growth is actually, I should say, wage and salary growth has actually been a little bit less. And one of the ways that you can see this, you look at where we were a year ago, and Washington, D.C., Richmond, Charlottesville, Roanoke, were all growing at an accelerating rate. This is a year ago in October. You look at where we are today, and we're still up on a year-to-year basis, but the rate of job growth has decelerated. And I think a lot of that has to do with the uncertainty that surrounds the fiscal cliff. And this is the last point that I'm going to leave you on, and I have lots of slides. You'll be able to get the slides, but I'm trying to keep us on schedule. And I'll be available up here if anybody wants to come and ask any individual questions as well. But the last point that I wanted to leave you on has to do with how this uncertainty surrounding the fiscal cliff truly impacts the economy. Now, I look at things like an economist. I believe that every decision in life involves a risk-adjusted rate of return calculation, whether you know it or not. I mean, That means crossing the street, or when your dinner selection, is it going to be fish or steak? It's a risk-adjusted rate of return calculation, especially after you turn 50. But given that, businesses don't know what the rules of the road are right now. They don't know where taxes are going to be. We do know the healthcare law is the law of the land, but we don't know what it's going to cost us. And we don't know how changes in the tax law are going to impact our customers. And if you don't know those things, you can't make a risk-adjusted rate of return calculation. And so what's happening is people are putting off hiring, they're putting off investment decisions. And once we know what the rules of the road are, some of that is going to come back. Because we're putting off everything. And once we know what it is, some of that is going to come back. And what our forecast is that we're going to have a very slow start to 2013 because that's when the uncertainty will be the greatest. But once the cliff is behind us, and we will get a resolution, it may be smoother than we expect, it may not be as smooth as we expect, but we will get a resolution by the end of January. We'll probably get one sooner than that, but we will get a resolution. And once we have that, we think that growth will ramp back up to about 2%. But getting growth above 2% on a consistent basis is going to be tougher. We're going to have to come up with a longer-term solution on how we're going to reduce the deficit over the next 10 years, and it's going to be very hard. We'll have a couple of quarters where we're 2.5 to 3, but it's going to be very hard to sustain that when we're deleveraging at the household level and deleveraging at the government level. It's going to be very hard to sustain those high growth rates. So where that leaves us is we see the economy continuing to get a little bit better, not a whole lot better, but we think some of the talk about how if we go over the fiscal cliff, we're going to fall straight into recession. We think that that's overdone. I think that we've got enough momentum, and it's broadening in such a way that we should be able to avoid a recession without, I don't want to say no matter what happens with the fiscal cliff, but absent a complete blow up in the negotiations surrounding the fiscal cliff. With that, I have run out of time and we're up against a break, so I'm going to end it right there. Thank you very much.